Welcome. I'm your host, Alex Codadat, and real estate broker with Alex Talks Real Estate Show, and where I bring you value, content, and tips. And today with me, our guest, Janice Scott. We're going to be talking about the updates to the tax reform bill and the impact that it's going to have on the real estate market. So go ahead, Janice. Tell us what's going on. What do you have in?
All right. Well, we're expecting around Christmas, we'll kind of have a Christmas gift. It'll be, that's when they're expecting to sign the new tax bill into law.
Okay.
At this point, what we have is we have the House of Representatives who put their tax package forward, and then the Senate has voted and put theirs forward, and then it goes to the House Ways and Means Committee, and the two branches of the government end up kind of duking it out till they figure out which is the actual tax bill that will be signed into law by the president.
So it's not the law yet, but pretty much they have it down to what's going to happen.
Yes, it's unlikely that anything changes between those things. They've kind of narrowed it down to the specific issues. Some of the things are the same between both those bills, the Senate and the House, and so those things are likely to be that.
Okay. All right. Yeah, so tell us about the things that are going to, the updates or the a little more regarding the real estate. That's what, most of our viewers would like to hear about.
Okay. Yes. One of the bigger things is the home sale exclusion will change from 2 of the last 5 years. A person will have to live in their primary residence. If they want to sell it and exclude the gain, they will have to live there longer. It'll have to be 5 of the last 8 years. And so every 5th year is as often as a person can move from house to house and sell their properties. If somebody's trying to do that, to take their rentals, turn them into primary residence, they now have to stay there for 5 years. And that'll be in effect as of January 1st, 2018.
But for folks that have, let's say they bought it 2 years ago and now they want to go ahead and sell it, that's not going to affect them.
No, it won't.
It's only going to affect, it's going to go back to November 2nd, correct?
Yes, yes, it actually can. I mean, they would still be using the 5-year rule if they decide to sell their house. But I believe that's the way that works.
Well, I believe from the way I've read the bill is that if you live in the property, if you've already lived there and you've been in the 2-year, it doesn't impact you. But it retroacts to November 2nd of this year, of 2017.
There is a key date.
Right. So after 2017, if you buy a property, I believe if you've lived there 2 out of the last 5 years, you would have to pay capital gain. And from November 2nd moving forward, you would have to live in the property for 5 out of the last 8 years, correct?
That's approximately it.
Okay.
That's one of the proposals.
Right.
Anyway.
Because the impact that I can see on this is that, we have us as real estate broker and realtors, we have clients that, they accumulate real estate, and they have 5 or 10 rentals, and they live off of the stream of income that they get from the rentals. And then when they get to a certain age, they decide that maybe, I don't want to, I don't have any children, or I want to be able to cash out one by one. Well, then they start moving into them, right? This is what happened in the past. They would move into a property, they would live in the property 2 out of the last 5 years, and they would avoid capital gain if they were single up to $250, and then married up to 500,000. But that's going to change everything. And I know, statistically, they say that a homeowner lives in their house for at least 7 years anyways, but I still think that this will have some sort of an impact, especially on the baby boomers that have 5, 6 properties and now they want to get rid of them. It's going to make them think. So it's going to, we already have an issue with the inventory out there. This is just going to make people even think more, twice before they sell. So for our viewers and our friends that are watching, is you definitely want to make sure that once this becomes law, which I believe is going to be in Christmas, correct?
Right around there, they expect the bill to be signed in.
Right. So you would definitely want to talk to your CPA to make sure that, okay, well, if your client or your client does decide to sell, that they're not going to be impacted with that capital gain. So
yes, because some of the higher income people, like 500,000 above, I believe there's a provision proposed that could eliminate, or at least on a sliding scale, could bring some of that revenue, some of the capital gain to be taxable, make it taxable. There is one proposal about that, and it's only those above 500,000, I believe.
Right.
And that's proposed. It's not signed into law yet.
Correct.
Of course.
So this is not law yet, but I believe in planning. She's a CPA. I'm a CPA. I mean, but of course I don't practice. I'm a real estate broker now. But I remember when I used to work at a CPA firm that clients would pay us thousands of dollars to plan for the following year. The problem is that you wait till next year to do your taxes for the prior year, where you need to do your planning now before next year. Same thing here. It's not into law yet, but it's pretty much written down in stone of what they're going to do. So you want to make sure you have your exit strategy, that you don't get stuck with a bill having to end up paying capital gains. So if that's the area you're going to have to sell, then if that's not going to work, then maybe you need to think about 1031. Maybe you need to think about, well, I need to pay capital gain now. So, but they're taking that away from us, but they're also giving it in other areas. What areas are they? That's their, they're saying that, yeah, you need to live there 5 out of the 8 years, but they're giving us somehow in some other areas. Where are they giving it back? In our standard deduction.
Standard deduction is a part of it. It's going to double for most people, so that a lot of people won't need to track their deductions after this. Like for individuals, go from 12 for a single person, like 12,000. It'll go to 24,000.
Okay.
For married couples, it'll go to 24,000.
Okay.
12,000 for individuals. I said.
Okay.
Say individual.
Now, what about the interest? They talked about, you can deduct up to $1 million, and now it's going to go down to 500,000. Can you
That's right.
tell us about that?
That's right. So, and that's where that November 2nd rule comes into play. That date comes into play. That mortgage home equity. There's a rule that it will no longer be deductible. The mortgage equity lines will no longer be deductible, but they will be grandfathered in for those that go into for those that have had them in the past. It's just that if you add new equity line to it, or you pay it down and then you spend it up again, you're not going to get the deduction. It looks like you're not going to get the deduction on the equity line.
So let's say, for example, right now I have a home. And I owe more than 500,000 on the mortgage, and I have a second, or I have a line of credit for 100,000. I haven't used it now, but I decide to pull money out of that line of credit, and I'm not going to use it to renovate the house. I want to use it because I want to go to Las Vegas, or I want to go on a vacation. That is no longer not going to be deductible, correct?
That's right.
Okay.
That's right. It still would be if you use it to improve the house. If it's a rental, anyway, if it's your primary residence and it would be deductible if it's a rental. But if it's a primary residence, you won't have that deduction if you're going to take on a new home equity loan, and right. It's above 500,000. So
now I know the confusion comes here, and I know a lot of people are going to think about this. They're going to say, wait a minute, you have $800,000 loan, and what are we only going to be able to deduct the first 500,000 and not the rest of this? But it doesn't work like that. It's more like a proration. Correct? Mm-hmm. So for example, if you have an $800,000 loan and 500,000 of it could be deducted, they're going to take that 500 divided into 800,000, whatever the percentage comes, then your monthly, whatever you were able to deduct on your interest, only then you will only be deducted, let's say 60% of it or 65% of it. So it gets more complicated, and I know it's going to be more complicated for us as real estate brokers and realtors, but you have to be able to plan this, and you want to be able to make sure that you're ahead of the game. So thank you guys for you guys are watching right now, Jenny, Aria, Heli, Habib, Sahar. So if you guys have any comments or questions, please put them through. This is a Facebook Live, and afterwards it's going to be replayed. And this is something really important, especially for homeowners, that they need to understand this, so you're able to have your exit strategy. For us as real estate brokers and realtors, when we go on a listing appointment, we're asking our client, what is your exit strategy? Have you lived in this property for more than 2 years? So this is mainly going to affect your primary resident, this really doesn't have an impact on rentals, correct?
No, they
So
should still be able to do that.
yeah, so thank God that on your rental property, so if you have rental properties, you're able to, you know, deduct the mortgage on there, your interest, but when it comes to your primary resident, they're taking it away. So it might, I don't know if it's going to hurt the home ownership, you know, the dream of owning a home. It might have an effect on it on a short term. The only concern that I can see is the baby boomers. I'm talking about, you know, the baby boomers that are going to come in. They're going to, you know, the ones that have 5, 6 properties. Now they're thinking about disposing of them. They went into one and lived there. Now they're going to have to think twice. So for us as real estate brokers and realtors, we really got to make sure that, you know, we have that talk with our seller. Or if a buyer is going to buy a property, they need to understand that if they buy a property and only live there for 2 years now, that if they do decide to sell, they're going to pay taxes if it's going to be their primary resident. Well, now, if a buyer buys a property, most likely they're going to have to live there for at least 5 years. So it's going to have mostly impact on primary resident and not really on rental. Hi, Pankaj. So, you know, and thank you, Sahar. I really appreciate that you're enjoying this. So what else do we have for real estate? And if not real estate, the other area that's going to have an impact on taxes?
So there's a shortened tax recovery period for depreciation on commercial property. Instead of 39 years, it'll be down to 30 years.
Okay. So for those of you, so what that means that before, and this has to do with commercial building, right?
Yes,
so
right.
When you bought a commercial building before, let's say you bought it for $1 million, you can depreciate it over 39 years. Well, now you can depreciate it over 30 years. So that means that you can write it off much faster. Is what we call in the CPA world, we call it phantom depreciation or phantom expense. So, and that's great. That's great news. For folks that are buying commercial building, they're able to write it off much faster. What else do we have?
So there's also the property tax deduction will be maxing out at $10,000 as an itemized deduction, not, as far as we know, not for rentals.
Okay.
It's only going to be for itemized deductions on Schedule A.
Okay.
And so some people may be better off to pay their extra bills that may be tax deductible, take them this year by December 31st, because you may not need them next year.
Okay.
If you're going to take the higher standard deduction. So if your itemized deductions on Schedule A are $12,000 or less if you're single, and $24,000 or less approximately if you're a married couple, then you're going to take a look at that and possibly accelerate your deductions into this year, because you may not need them, or may not get a benefit next year.
Right. One of our viewers, Helly, she has a great question. She says, are these information for state of California? This is actually federal. This is for all 50 states, guys. So all the 50 states you live in, this is going to apply to all 50 states. Now, each state has their own state, law when it comes to taxes. But what we're telling you is at a federal level. So this is going to impact everybody in the United States. Okay.
And yes, for most of the states, they wait till the federal is in place, and then they make adjustments if they're going to, that may agree with the federal changes later in the year, and they'll make them retroactive a lot of times till January 1st.
Right.
And, so that's what's possible at the state level. So there's a little bit of there's some changes yet.
So another thing she just brought up was regarding property taxes. We live in Northern California, and for some of our viewers that are watching, as you guys know, in Northern California, some homes, the property taxes are $15,000, $20,000, $25,000 a year. Well, you're telling me that on your primary resident, once this goes into law, that you could only deduct the $10,000, correct?
Yes, that's right.
Okay. So, I mean, it seems like this is really going to hit folks that have a bigger loan, bigger homes. That's going to have an impact on those. So, for those of you that are helping your clients buy homes at a higher end, you need to really think about this, and you need to actually educate your client on this to let them know that, look, we're buying this house. If your property tax is going to be $1,500 a month and it's $18,000 a year, you're only going to be able to deduct 10 grand of it and not all of it. So it's all about planning. That's why with our shows, it's all about empowering you, the consumer, the viewer, to be able to make better decisions for you and for whoever else that you're trying to help.
That's really important because you don't want any surprises at the last minute. It's better to pay a couple $100 or a little more if you have a complex tax situation, and know what to expect. Know whether to pay your state taxes this year or next year. It's a little bit hard to know this year with the new bill coming in, but still, there's a lot you can do.
Right. So guys, if you guys have any question, this is your chance. I mean, after this, it's going to be a replay, but if you guys like, you guys can go ahead and call, not call in. I'm so used to my TV show back in the days. People would call in and then actually talk. But that's actually not a bad idea. Maybe I should do one with people calling in also too. But you guys can, put in your comments in here if you have any questions. But the main thing, you need, if this thing, which pretty much is a done deal, you on your primary resident, you need to live in the property 5 out of the last 8 years to avoid capital gain, up to $250,000 if you're single, and up to $500,000 if you're married, and interest before you were able to deduct up to $1 million. Now it's going to go down to $500,000. Property tax, before you can, whatever on your primary resident or your rental, you can deduct all the property tax, but now on your primary resident, you will only be able to deduct up to $10,000. Now, this is not law yet, but I'm getting you guys ready. Okay, because when it goes into law December 25th, I'm just giving you guys a head start. So just be ready when it comes to this. Now, what they've done, they're taking away some of our deduction, but they're giving it to you somewhere else. So you're, like the standard deduction, right?
Right, that will go away too. Most
that's
the way it looks. But in exchange for that, and the exemption, personal exemption, is therefore. I'm talking about personal exemption. That's going to go away. It looks like also.
Okay.
That's on page 2 of your tax return. So not only is the standard deduction changing, but the personal exemption is going away. It looks like, and there'll be instead a $300 per person credit that's called a family credit.
Okay.
And so it's hard to say exactly how that's going to impact people. It just depends.
Right.
On their tax situation.
Yeah. So, anything else we need to know about, Janice?
For higher income taxpayers, the alternative minimum tax, it looks like, is not going to be in effect any longer, and it will be for corporations, but not for individuals. And so that can be a plus because that is limited the itemized deductions like the state tax deduction and the property tax deduction and some of those things for higher income individuals for a number of years, and that's going away. So
okay, all right.
Positive.
So, well, guys, just want to kind of give you that little tips, and hopefully it helps. And like I said, if you guys want to reach out, please share this video. You guys can also follow us on Facebook and Instagram and subscribe to my YouTube channel. I will be having Facebook Live every Tuesday night at 6:30 p.m. and it's about 15 to 20 minutes. And I will be bringing on different guests to talk about matters affecting the real estate market. It will be title companies, there will be real estate attorneys, CPAs, interior designers, home inspectors, and the whole purpose of this show is to give you guys value, content, and tips, and hopefully it'll help you with your decision making. But like I said, please share this video, give us a thumbs up, and put in your comment, and hope you guys have a wonderful evening. Thank you so much for coming, Janice. And then once this thing becomes law, after, I think that's going to be our Christmas gift. Once it becomes, for some people, there's going to be a Christmas gift. For some people, there might not be a Christmas gift. But anyways, it is what it is. So once it becomes law, then we will be able to give you exact update on what's going to happen. But remember, guys, it's all about planning. We spend more time planning for our vacation than we do for our finances. That's why you need to start planning now for next year for your tax return. Do not wait for next year to do your planning of your tax return for 2017. You want to plan now. So I just kind of give you a little heads up here and some tips on what you need to do or be ready for. Okay? Hope you guys have a nice evening, and thank you for all these people. I love it. This is the first Facebook Live, and we have all these people. My favorite, Tony, thank you so much for watching. Cremena, Fati, Yelda, Frank, Heli, Sahad, Jenny, all of you guys, Pankaj, thank you all for watching. So you guys take care, and do you want to add anything else, Janice?
I don't think so.
No? Okay, so we'll talk to you guys later. Bye.